So hello all, good evening. So welcome to this short learning session on supply trading. So today's market gave a good example to illustrate this concept. So that's why I'm making this short video. So first, let me explain the concept of supply trading as I mentioned in the thumbnail. So supply trading usually as the name goes, we are talking with respect to supply and demand. Supply means there is more, consider that this is a particular price level, right? You can also consider this as being a zone also. So what happens is when there is more supply at this level, the sell orders are, think that there are more sell orders, at this level, right? And then what happens? The price, aggressively falls, right? The fall should be very, aggressive. So what this usually means is that the institutions in the sense the FIIs and DIIs are shorting or selling at this particular point, and their selling is visible through to us through such big range candles. And what happens post this is once big move comes towards the downside, then what happens? The price. This is the first leg of the move. So this is the first leg of the move, and since institutions cannot fill their orders at once because of the liquidity issues inherently present. So what happens? Usually the price retraces back to the supply zone and gets rejected, and again it is sold into with the same speed, right? Because this is the first leg and this is the second leg. So here comes the shorting point, right? So this is the shorting point of the big institutions. So here, once this is done, once the price gets rejected at this supply zone, either through you can see this either through rejection wick of the candle or any other bearish candlestick pattern, and below that you enter the short position with the stop loss above this. So this is simple, and the target can be the first swing. This is the first swing, which was the initial leg of the selling, and the next targets can be based on depending on the chart context. So this example was visible today when with the two examples I will share. One is Nifty, obviously, and second is Axis Bank. So as we can see on the chart, I have marked this out. So let me first clear this drawings. Okay, yeah. So as you can see here, this is the example of Axis Bank, which I think, as you can see, this is Axis Bank today's chart on a 15-minute time frame. So this this was Axis Bank's yesterday, that is 17th, and which is today's price action. So yesterday Axis Bank, the first rejection happened the opening. Post that the candles the price slowly went up in a grinding fashion. This is generally not a good buying, you can say. And then the price after coming at this point, it sees a sharp selling, right? So this is the point of observation that this is a very sharp selling which takes place from the institution. Sharp selling is the simple reason behind this sharp selling is because institutions are selling this. See, institutions generally don't sell or buy in small quantity, right? So whenever they do so, that is the phase of indecision in the market. But whenever they do with real intent, we all know that the amount which has gone behind buying or selling of any particular candle would be in crores. In fact, sometimes it can be even tens or hundreds of crores. So this candle shows that this aggressive selling has been done by some institutions, be it DIIs or FIIs, or maybe a collective group altogether based on some particular broad interest. So we just have to find out the origin of the move. So origin of the move, in the sense, the green candles which are prior to the origin of the move. So for example, if this is the origin of the move, the previous candles, right? For example, this can be considered in this context the green candles to mark out the zone. So as I mentioned here, mark the range of the green candles prior to red candle, post which the aggressive selling has happened. So we've already witnessed this aggressive selling. Go back to the origin of the move and mark the range of the previous candles which have this you get the shorting range. Basically this is the supply zone. So this zone is called the zone of supply, which means there are sell orders which are strongly present at this particular zone. So whenever price reaches here, so based on the price reaction, one can easily come to a conclusion that yes, the price can be shorted at this particular point because the institutions are also shorting. So you get a strong conviction to short at this particular point. So observe that today when the price reached, again, as I said, the price heads back because to fill the liquidity. So that's the reason why the price comes back again to short. So once the price heads back again, just see the reaction of the price. You can see that price is making a big shooting star type of a candle, right? So we already know that this is a zone of supply, and the price is confirming the same through the shooting star candlestick pattern, which is a bearish rejection pattern. And the entry for this has to be once the low of this candle is broken. Entry, this is the entry point, and then the first target can be the previous swing. So this is the swing level in this context, and that's how you enter based on the. Of course, I'm showing this on the 15-minute time frame. You can obviously go to a much lower time frame to observe the rejection at these levels, and then take entry accordingly for better risk reward. So that is the overall concept. So just notice the aggressive selling which has taken place from institutions. Mark out the previous zone from where the move originated and extend that zone. That becomes a zone of supply. And whenever price comes back there, see, usually it can come back within a day or maybe a couple of days or maybe some 3, 4, 5 days it might take to for the price to eventually come back to that zone of supply. And from there, as we know that price has memory, so this zone acts as a zone of supply, and the selling orders are triggered and the aggressive selling begins. So this is the concept of supply trading. Basically, whenever there is a context of demand trading, I'll explain the concept of demand trading, but that is as simple the opposite of whatever I'm trying to explain on the other side. Now let me use the example of Nifty also on today's chart. So as you can see, Nifty also is almost, you can see the example is very much similar. Yesterday there was a sharp aggressive selling which took place in Nifty. So this is the aggressive selling which usually you can make out either through a long range candle, right? So, and the price displacement, the body, the candle is not having much of the wicks, it's full of body, right? So this is strong aggressive selling. So go back to the origin of the move. So, and just mark out the prior candles. It can be a green candle also, or it can be a doji also. So this is the zone of supply. So generally, for a factor of safety, you can even consider this broad zone also. But the concept precisely means that this is the exact zone of supply, the origin of the no. But you can also consider this broad range. So anyway, price is just a range. So you can consider a range also, not an issue. So and wait for the price to slowly head back towards the zone of supply and observe the rejection which is taking place. So this is the rejection of the price which is happening at the zone of supply, and we can see the wicks appearing. And then this is also confirmed by the next red candle. When the low of that is broken, take the entry for the short side, and the target can be this on the first particular point. And the other targets can be based on the swing points of the respective charts. Here in this case, there was a gap, so you can expect that the gap can be filled. This can be the first target. I mean the second target, subsequent targets post the swing targets. First was the gap zone. As we can see, price took a bounce after it hit the zone of gap. Then it continued its downward journey, and maybe somewhere here this can be second target, and that's how the overall. Anyway, targets is not in our control. Only what is in our control is stop loss and entry point, which has to be well thought out based on the chart. So it's almost both the examples are pretty much similar. One is in Nifty, one is in Axis Bank. So the same works on any different kind of chart, because on chart what we're seeing is the footprints of the big institutions as well as even retail participants also. So knowing that can help us to take some prudent trading decisions. So that's it for today's short learning on this concept of supply trading. I hope it was helpful. Thank you.